Hello, my friends. Welcome back to my channel. Philip, a bit mindful money management. If you've been watching the news for the past 3 to 4 months, you must have heard about the Federal Reserve increasing interest rate at an unprecedented rate. But what is the Fed? What is the function of the Fed? What does it mean when the Fed said that they will increase interest rate by 50 basis points, 25 basis points, or 75 basis points? And when the Fed talk about increasing interest rate, what interest rate are they specifically referring to? And finally, how are the actions of the Fed impact the amount of interest we pay on mortgages, student loans, auto loans, personal loans, and credit card interest? I will answer all those questions for you guys today because I find it disturbing that if I ask some young adult what is the Fed, what is the function of the Fed, most of them will not be able to give the appropriate answer. And far fewer would even know that there is something as the Federal Reserve. This is surprising considering the amount of impact the Federal Reserve have on how much money we have available to spend from our disposable income. What is the Fed? The Fed has, by the act of Congress, has two main responsibilities, and that is to keep inflation at 2% or below and to keep unemployment low. To achieve this, the Federal Reserve control the amount of money that is available in the US economy at any given time. Its most powerful way of doing this is interest rates. If the Federal Reserve increases interest rate, money becomes more expensive. Thus, less people are more likely to want to use it. If the Fed reduces interest rate, money becomes cheap. Thus, more people would want to use money. But what interest rate are we talking about specifically? The Federal, the two main interest rates that the Federal Reserve have is one, the discount window interest rate. And this is the amount of interest the Federal Reserve charges banks to borrow money from it. The second interest rate, and this is the one that the Fed is referring to when they talk about increasing interest rate, is the Fed fund rate. This rate is the amount of interest banks charge each other for overnight short-term loan. By law, every bank in the US has to maintain a certain percentage of their total deposit with the Federal Reserve. Let's say Bank A and Bank B have to maintain a deposit of $10 with the Federal Reserve. Bank B happened to have $13 on its books on that evening, and Bank A only have $7. Bank A, in order to comply with the law, needs to borrow an overnight short-term loan from Bank B of $3. Bank B decide to lend Bank A the $3 at an interest rate of, it's currently at 4.75%. That 4.75% is the federal funds rate. And that is the interest rate the Federal Reserve is referring to when they talk about increasing interest rate. It's the overnight short-term interest rate banks charge each other to lend money to. When the Fed talks about increasing the federal funds rate by 25 basis points, by 50 basis points, or 75 basis points, all you need to do is take a decimal and put it in front of the main number, and in front of the decimal put a zero. For example, if the Federal Reserve says they're increasing interest rate by 25 basis points, what they're actually saying is they are increasing the interest rate by 0.25%. If the Federal Reserve says they're going to increase interest rate, which is the federal funds rate, by 75 basis points, what they're saying is we're going to increase the interest rate by 0.75%. Previously, about 2 weeks ago, the Federal Reserve increased the federal funds rate by 25 basis points. So that was 0.25%. No one has to charge interest. The Federal Reserve can't tell banks how much interest they should charge. In fact, if banks don't want to charge any interest, they don't have to do it. The federal funds rate is the basis. It is the starting point from which all financial institutions start to calculate how much interest they will charge us for various loans. The rest of the interest rate that we pay has to do with our credit score. If you have a credit score that's over 700, you are considered to be someone of good credit. Thus, you may have a lower interest rate. If you have a credit score below 700, you're considered someone to be of questionable credit, as I like to put it, meaning you are a riskier borrower, which means you will have to pay a higher interest rate. Before you even walk into your bank to get a loan or to get a credit card, you're already being charged whatever that federal funds rate is. And it currently sits at 4.75%. If you have a variable interest rate on a credit card, on a mortgage, or on a personal loan, every time the federal funds rate changes, whether it goes up or goes down, your interest rate month by month changes. This is why getting a loan with a variable interest rate, in particularly a mortgage, is a terrible idea. And I have no idea why people keep doing that. This is why for us, we need to understand what the Fed does. We need to understand the role the Federal Reserve play in our lives, because every decision that the Fed makes impact us. It either puts us in a situation where our dollar is worth more, or our spending power from that $1 is worth less just by manipulating the federal funds rate. This is why the famous saying on Wall Street is, you never mess with the Fed, because the Fed can literally make or break us as individuals, and they can make and break banks as institutions. All right, I think that's it for this one. Very short, simple, sweet. If you guys have any questions, comments, suggestions, or anything you would like me to cover, please leave it in the comment section below. And most of you who watch these videos are not subscribed, so if you can, please subscribe, turn your notification bell on for all the new and exciting content we have coming up on this channel. My name is Philip. This is Mindful Money Management, and thank you guys for watching. Until the next video, spend wisely, my friends.